Picture this: you made $50,000 trading last year. You're celebrating, planning how to spend your profits. Then April arrives, and your accountant drops a bombshell: you owe $23,000 in taxes plus penalties for mistakes you didn't even know you made. This isn't fiction. This happens to thousands of traders every single year because nobody warns you about the 5 critical tax traps that can destroy your trading profits. I'm going to show you the exact tax landmines that cost traders tens of thousands annually, and more importantly, how to avoid them completely. Whether you made $500 or $500,000 trading, these rules apply to you. And if you ignore them, the IRS will find you. We'll cover the Form 8949 nightmare, the wash sale trap that costs traders $10,000 plus annually, trader tax status that could save you thousands, and the record-keeping system that actually works. Let's dive in. First, let's talk about Form 8949, the form that makes grown traders cry. Here's what your broker doesn't tell you: you must report every single trade. Look at this actual form from a day trader: 847 individual entries, each requiring specific information. Your broker's 1099-B shows gross proceeds of $125,000. Looks good, right? Wrong. This doesn't show your actual profit. You need to report each trade separately: date purchased, date sold, proceeds, cost basis, and gain or loss. Miss one trade. The IRS assumes 100% profit on the missing cost basis. Here's the kicker: your broker follows simple matching rules, but the IRS follows complex, substantially identical rules. Your broker might not catch wash sales between your stock and options accounts, but the IRS will, and they'll disallow those losses. The wash sale rule is the #1 profit killer for active traders. Here's how it works: if you sell a stock at a loss and buy it back within 30 days, before or after, you cannot deduct that loss. Let me show you a real example. January 5th, you buy 100 shares of ABC at $50 equals $5,000. January 15th, you sell at $40 equals $4,000. You think you have a $1,000 loss. January 25th, you buy ABC again at $42. Result: your $1,000 loss is disallowed. It gets added to your new cost basis. But here's where it gets dangerous: this applies to substantially identical securities. So if you sell Apple stock at a loss and buy Apple options, or an Apple ETF, within 30 days, you trigger the wash sale rule. Most traders don't know this and lose thousands in tax deductions annually. Now, let's talk about trader tax status. This could save you thousands, but 90% of eligible traders never claim it. If you qualify, you can deduct your trading expenses as business expenses instead of limited investment expenses. As an investor, your expenses are limited and often not deductible. As a trader with TTS, you can deduct home office expenses up to $1,500 per year simplified, trading education and courses, professional subscriptions and software, computer equipment and internet, and professional fees and tax preparation. To qualify, you need to trade frequently, substantially, and with continuity. The IRS looks for 4+ trades per day, most days, seeking profit from short-term price movements, not long-term appreciation. If you qualify, you file Schedule C and treat trading as your business. Here's the system that will save you during an audit. The IRS requires contemporaneous records. That means recorded when the trade happens, not later. You need to track trade confirmations with exact times, market research and analysis notes, news events affecting your decisions, business purpose for each trade, and equipment and office expenses with receipts. Use a dedicated trading computer, separate business bank accounts, and cloud storage for automatic backups. This system took me 2 hours to set up and saves 20+ hours at tax time. The key is automation. If you have to remember to do it, you'll forget. Here's a mistake that blindsides traders: thinking trading income is subject to self-employment tax. Good news, it's not, unless you're trading on an exchange floor as a member. Trading income is not subject to the 15.3% self-employment tax, even with trader tax status. This saves you thousands. However, if you provide trading advice or manage others' money, that is subject to self-employment tax. Know the difference. Don't get hit with penalties. If you expect to owe $1,000 plus in taxes, you must make quarterly payments. The deadlines are April 15th, June 15th, September 15th, and January 15th of the following year. Pay 100% of last year's tax liability, 110% if you made over $150,000, to avoid penalties. Set aside 25 to 30% of your profits in a separate tax account. Use the IRS estimated tax worksheet or hire a professional. Here's your immediate action plan. First, download the trading tax checklist below. Second, set up your record-keeping system this week. Third, determine if you qualify for trader tax status. Fourth, calculate your quarterly payments. Fifth, find a tax professional who understands trading. Don't let tax mistakes destroy your trading profits. Thousands of traders wish they had this information before filing. If this saved you from even one costly mistake, hit the like button and subscribe for more advanced trading education. Your future self will thank you.